Good morning, everybody, and welcome to this month's IFRS and Corporate Reporting webinar. This month, we're focusing on financial statement hygiene, and we have some key takeaways from the 2024 reporting season. Now, the timing of this session was really planned because we know a lot of entities with 31 December year ends are currently finalizing those financial statements, looking at their disclosures very carefully. So these are a few reminders on how to make sure that your financial statements meet the mark from a disclosure perspective. But also, even if you're a 30 June a year end and you are maybe now working on your interim financials, some things to think about as well. I think it's important also that when we round out a particular year and we finish off 2024, that we take stock of what we've learned and what we can do better in 2025. And that's what we're trying to do in this session. Of all the financial statements that's been reviewed in 2024, what are some of the lessons that we can improve those financials? So a bit of an introduction, why this session in the month of February. It's our Valentine's Day edition, and we're talking about financial statement hygiene. So today in this webinar, I'm joined by Dean Arden, who's our new IFRS and corporate reporting partner here in Melbourne. So Dean will do most of the heavy lifting, and there's a little bit of a reasoning for that. Dean, for many years, at BDO have looked not just at advisory clients, but oversaw the team that reviews financial statements of our audit clients. So Dean and his team have a lot of knowledge of reviewing financials and what are the things to look out for. They do these reviews usually, it's been put in front of them by the auditor, and they review it. They don't usually have a lot of knowledge of the client. It's a cold review and not a lot of background. So if I'm a user and I get the set of financials, what would be the things standing out? And what are the things that would bother me? So it's from that perspective that we've picked up all these things. So Dean will be looking at that today. So BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. And we pay our respect to their elders, past and present, and we extend that respect to all Aboriginal and Torres Strait Islander peoples here. Our IFRS and corporate reporting webinars, we had our What's Hot and What's Not in January. Today, we're looking at financial statement hygiene. And then if you look at the blue blocks, it's all the webinars we've scheduled for the year. I think next month's webinar, where we look at accounting for power purchase agreements, is going to be fascinating. A lot of developments, some standard setting developments, but you can see a number of interesting topics scheduled for the year. We also now have our monthly sustainability webinars. Last month in January, we looked at 2025 is the year of mandatory sustainability reporting. Are you ready? Please get ready. But this month and actually next week, we'll be looking at the strategic role of AASB S1, which is a voluntary framework in Australia, and other voluntary frameworks. And then for the rest of the year, we'll be focusing on the mandatory standard in Australia, AASB S2. And then, these masterclasses, when we came up with this idea around this time last year, a few people were thinking, really, carbon accounting masterclasses, are you sure? So I take great pride in saying back due to popular demand. It was such a success in May last year and November. We had more than 250 businesses through this program last year. That we are scheduling another series. I'll personally be presenting the one in Melbourne face-to-face, and I'll be presenting the virtual one on the 20th of March. The Melbourne one is soon on the 4th of March. In Perth, Ashley Woodley will be presenting it. In Sydney, our friend Kevin Frobers, and in Brisbane, Tom Hogben. And you all know Kevin because he's usually on these webinars as well. So please register for those. All roads lead to carbon accounting, whether it's strategic sustainability or compliance sustainability. It starts with carbon accounting. Then if we look at today's agenda, maybe to add to the introduction, I think what we often see is that clients spend a lot of time looking at the accounting treatment of various complex transactions. Auditors focus a lot of time auditing complex transactions. But we have to remember, in the end, all of these transactions end up in financial statements, and the financial statements are the way that the entity is ultimately communicating with their shareholders and their stakeholders. So we want that end product, the set of financial statements, to be high quality. And therefore, we want to make sure that we address all of the disclosure aspects as well. And if there are little things, they can irritate the user, because we might have had high quality accounting, high quality auditing, but if the end product, those financial statements and the accompanying audit report, is not a high product, that's the only thing the rest of the world sees. So the real focus on the financials today. I think what we've seen in 2024, Dean, is a lot of people still leave the actual preparation of the financial statements way too late. So by the time you and your team get the financials to review, it's right at the end. A lot of people say good comments, we don't have time, everybody's exhausted. So I think one of the practical problems is, how can we get these financial statements in a position that the technical teams can review it and the auditors can review it at an earlier stage? That would naturally improve the quality of these financials. I think this cannot be a last minute thing. And then maybe a final comment before I look at the agenda. I think it's really important, CFOs, CEOs, audit and risk committees, boards, they are primarily responsible for these financials and the quality of these financials. The auditor do audit work and express an opinion, but the responsibility for the financials is that of the CFO, CEO. They actually sign declarations, and the audit and risk committee and the board. So it's important that everybody consider, how does this final product present to the market? And really, that's why we have the webinar. So Dean has organized his presentation into 5 quick fixes, which I like. He also says there are some reporting issues that require some hygiene or better hygiene. And then there's perennial disclosure challenges for financial statement preparers. So today we're not going to razzle dazzle with actual debits and credits and accounting treatment. The idea is to razzle dazzle with fancy disclosures. So Dean, I'll hand over to you.
Thanks, Aletta. I just want to add to maybe some of those comments, just to clarify sort of some things that we're going to talk about today. One of the things, and just following on from the quality discussion, the quality points you raised just before, in a former life, I worked in regulation, and I can tell you now, as a regulator, one of the things that you are looking for is anything that indicates quality is not at the forefront. And so when I was always reviewing financials from a regulator's perspective, if I saw things that indicated to me that maybe the entity wasn't putting enough effort into maybe the description of their accounting policies or in the presentation of their financials, that was always a really strong indicator to me that maybe there were other things that were going on. So if they weren't getting the editorial right, they weren't getting possibly other things right, and that would be something as a flag that I would use to basically identify entities for further investigation. So, and I think we're seeing that in the market now. Like, I think we're seeing ASIC is you really using that as an indicator of, is this entity got potentially other issues that we would that if we actually started asking questions, might find out further information about them. So from my perspective, and too from an audit perspective. I think it's really important you get that quality up front, because you're trying to present to the market the best face that you have to the market, and convincing them that you're worthy of investing in. Now, from a regulator's perspective, I think that's really important, because I think regulators do use those sort of indicators around sort of quality of disclosures and content as primary indicators of whether or not they want to go and look at that entity further and actually start to send letters to them and ask questions. So I think from that perspective, even if you don't think editorial is important, I think it's really important from the perspective of, do you want to spend your time responding to ASIC queries, or do you want to actually spend your time doing things which are important to your business? So from that perspective, I think it's really important, the quality side of it. Also point out today, a lot of the things we're going to talk about today come from the reviews of financials of clients and other entities we've dealt with during the year. Where we get this information from is usually from their first cut of their financials. So we don't normally, the list of topics I'm going through today is not indicative of what's in the final product of the financial statements. It's just indicative of what we first saw in the first cut. So it's an indication of where the client initially got to with their financials. The other thing I wanted to call out today is when you get a message from your boss on LinkedIn that says the presentation today is going to be fun, and she actually uses all capital for the word fun, it does put a little bit of pressure on you. So I'm going to really try and bring my comedic A game to this presentation if I can, but unfortunately the material is quite serious, so I'll do my best. I'm only going to do my best. Okay, let's push on. The 5 quick fixes, I think the best way to contextualize them are things that we see regularly, and we sort of think to ourselves, this is something that really just shouldn't be an issue. Like it's some of the requirements behind them are a little bit complex, but entities have been doing this for a long time. They shouldn't be getting this wrong. First one is rounding. Rounding really doesn't have to be that hard. To give a little bit of context to rounding, it's important to understand that the Corporations Act doesn't have a natural harbour for rounding or for materiality judgments. So the Corporations Act simply says you present your financial statements and it's in Australian dollars. Now, it says nothing about dollars and cents. It actually just says Australian currency. And so as a consequence, there's nothing naturally in the Corps Act that allows you to round to the nearest cent or to the nearest dollar. So as a consequence of that, this is why there's the ASIC instrument, the 2016-191. What it does is give ASICs the capacity to relieve entities from having to round to the nearest cent on certain things, and actually then allows a more practical and more feasible sort of presentation of their information. Now, there is differential relief available for entities, subject to the nature of the thing that you're disclosing and the size of your entity. So it's scaled by size. But I think the important thing to there, and as I mentioned in there in the slides, is that relief is available to lodging entities that meet certain criteria, including the relevant eligible report states that the entity is an entity to which the instrument applies and that the amounts have been rounded off in accordance with this instrument. So it's really important. It's a very standard paragraph, and I've included an example there. I cut that example paragraph out of a listed company's financial statements this year, not a BDO clients, but another entities. I've seen variations on that wording, but effectively it has to say what it says. If you do not have that paragraph in your financial statements, technically you're not complying with the corporations law, or that you are actually using the relief inappropriately. And so it's really important that you have that paragraph. Now, I do on occasions talk to people, and I reckon I've been doing this for 20 years. I reckon every year I see an entity that hasn't got the rounding paragraph in their financials on the first cut. Now, it's something that we just simply say, just put it in. Some entities resist it because obviously there's some work to do, but as an example of a paragraph that can solve a lot of problems for you, I think it's really a good one. With the slides, what we've done is I've provided, and I appreciate the ASIC instrument it's not an easy read. It's actually quite a complicated read to get through and to understand exactly what rounding applies to and who. But what we've done, and thankfully, shout out to Kate and to Alison who prepared a couple of these slides for us. We've provided a summary of exactly what the rounding requirements are. Now, as you can see in this slide, until you get to about 1 billion in total assets, rounding is pretty fixed. Okay, it's only when you get really to about 1 billion or above, in terms of other things, above 10 million, that's when rounding starts to kick in. But essentially, it's to the dollar for most entities when you're under $1 billion of total assets. And again, we've provided also a little bit of guidance. So in terms of rounding, the rounding instrument also applies in the context of accounting standards. So in terms of numbers reported within your annual reports that are lodged, they have to be subject to those rounding requirements. Hopefully that's helped. Hopefully we don't see any other rounding issues going forward. It's one of those ones that's perennial, that pops up all the time. And sometimes it's to do with that thing where maybe someone has to sit down and read through the financials, or particularly the director's report and the REM report, one more time just before you actually lodge them, and just one more time before you provide them to the auditors, to be able to say, yep, everything's consistent within it, the rounding's all consistent. Second topic I wanted to cover was the unreasonable prejudice exemption that's in the Corps Act. Now, under Section 299 1E of the Corps Act, it requires you as an entity in your OFR and other statements to provide likely developments in the entity's operations in future financial years and the expected results of those operations. Now, Section 299.3 actually gives an entity the capacity to omit material from the report otherwise required under that section if it's likely to result in unreasonable prejudice to the entity or to the consolidated group to which the entity belongs. Now, if material is then omitted under that, the report must say that's the case. So something's actually been omitted. So if you rely on that unreasonable prejudice exemption, you actually have to say that you're relying on it. Now, it's really important to understand that what that's there for. And what it's there for is to deal with situations where there might be something that's very imminent and very significant, but if you were to disclose it at this point, it might cause unreasonable prejudice, in the sense that it might cause maybe a potential transaction or deal to fall over, or for example, a claim to be become more onerous than maybe it was going to be, subject to the negotiations you're involved in. So it's really important to understand it's there for a very, very specific reason. Now, I think what's happened in the past is that model financial statements have always included that statement about we're not disclosing anything further because of unreasonable prejudice, just as a way of demonstrating how that disclosure might look. But a lot of entities have then taken it on board and said, oh, well, that's the disclosure I make. You need to be really careful of that, because ASIC has pulled up a number of entities in recent times where that entity has relied on that unreasonable prejudice requirement, and then subsequently disclosed to the market something that they hadn't put in their financials. Now, in that situation, ASIC genuinely has the right to ask the question, why didn't you disclose it in your financials? It's not unreasonable prejudice if you then in turn disclose that information to the market. And that's been the basis that we sometimes go back to some clients and some other entities that we deal with when dealing with this type of situation, to say to them, is there genuinely something there? Is there something that could cause you loss? Or is it just is it a boilerplate disclosure that you've just popped in and just making sure you're covering yourself off? If it's the latter, really think about whether or not you want to include it. If there is nothing else to disclose, then that's what your financial statement should say. We've disclosed in our financial statements and in our subsequent events notes all that's significant to the entity at this point in time, and that's all you need to say. You don't need to worry about saying an unreasonable prejudice exists or that you've relied upon it. So be very careful with that. It's got a significance that sometimes people forget. Third one, how much is too much non-IFRS information? I mean, ASIC doesn't prevent non-IFRS information. I mean, ASIC welcomes it in many respects, in the sense that it's useful. It can be useful to explain exactly what's going on with an entity's operations and financial position. And so as a consequence, there is a scope for non-IFRS information. The issue that we have, and often we raise this with entities, and we know ASIC, and the reason why we're raising it with entities, because we know ASIC is very vigilant in this area at the moment, is that non-IFRS information can mislead or potentially be regarded as misleading users around the actual statutory financial results of the entity. Now, ASIC has a very strong view that underlying true and fair is compliance with Australian accounting standards. If that's the case, then adding information to Australian accounting standards then may be considered to be, if not misleading, then not appropriate in the circumstances. ASIC are very clear in their regulatory guide 230 to basically saying, look, if you want to put non-IFRS information in, we expect to see it in things like the OFR or the director's report. And you've got to make sure that, and I've put it in the second dot point there, you make sure that you're actually covering off exactly what ASIC wants from that information. So it doesn't have greater prominence than the IFRS information. It's clearly labelled to ensure that it's distinguishable from the corresponding IFRS information. It's clear how it's been calculated, so you might have to actually explain if you're using EBITDA what you've included and excluded. And there's a reconciliation between the non-IFRS and the IFRS information. If you do that, shouldn't have a problem with ASIC. ASIC shouldn't have a problem with it either. But the important part is we do see entities putting these non-IFRS information in. Sometimes it's in financial statements, sometimes in OFRs and directors' reports. But it's important to make sure that it all lines up to ensure that ASIC is not going to be asking you the question, why are you giving this more prominence? Why are you using this number when you've got a statutory number that's actually, we think, is a reasonable, true and fair view of what your financial performance is. Rather, I suppose, a bit of tongue-in-cheek, don't overcook your cash and cash equivalents. I mean, what I'm trying to say there is be very careful about what you include in your cash equivalents number. I've provided there the definitions of cash and cash equivalents. I think the key parts I'd probably focus on there is on the right-hand side of the slide. If there's no history of using an item for short-term cash commitments, or there is evidence that they've actually used those cash equivalents for an alternative purpose, it is unlikely to qualify as a cash equivalent. Okay, so it's got to be used for, particularly for your short-term financing arrangements, so paying for short-term accounts payable, inventory, those sort of things. Just because there's 3 months or less left till maturity, and that, what I mean by that is as at the reporting date, on a term deposit, say, for example, that doesn't make it a cash equivalent. So the definition is about 3 months in total, not 3 months at the reporting date. We rarely see equity instruments included in cash equivalents. Typically the category includes short-term deposits and similarly liquid interest-bearing investments like any other kind of cash type deposits. We sometimes see classified as cash equivalents that call deposits that have relatively onerous penalties in the event that they are withdrawn within certain timeframes. But those are kind of situations where you really should seek advice on exactly whether or not that meets the definition of a cash equivalent. Because with the issue around the insignificant risk of changes in values, things like penalties for early withdrawal may or may not be regarded as in conflict with the definition of cash equivalents in those circumstances. Fifth one, be clear on the details of your group of cross guarantees. This is another thing we often see. There is obviously a requirement in the ASIC instrument 2016-785 to actually disclose who's in and who's out. Now, obviously, if everyone in your consolidated group is in your wholly owned cross guarantee arrangements, great, that's fine. You just have to state it. And then you have to disclose any guarantees. If the two things are not the same, more work's involved. And it should be it's often fairly evident whether or not all of the entities are within the group, because usually we can have a look at sort of where they are located, and those sort of things could indicate that they're not subject to the cross guarantees that exist with a parent. If that's the case, there's more work to be involved and it has to be disclosed. Now, again, this is an instrument, it's a legislative instrument, so it's not a case of an accounting standard that you can rely on materiality maybe to get around. It's important to say, okay, this is a legislative requirement. We have to make those disclosures. If we don't, we are arguably not in compliance with the Corporations Act. So that takes us to, say, some reporting issues that require a bit more hygiene. So I just wanted to sort of get those quick fixes out of the way because I think some of them are pretty easily applied and pretty easily dealt with. Now, when we come to those reporting issues that require some hygiene, I suppose what I'm thinking of is that it will take you a little bit more time to work through your financials to perhaps implement these. But I think that they're equally, if not more important than probably the 5 fixes that we've sort of talked about to date. First one, director's report. I often feel like the director's report's a fairly neglected report because often we review it because obviously it's a part of the financial report or the annual report of the financial statements. But often we don't see maybe that the attention is given to it that probably it deserves. Being a statutory report, it's really important, and there are some statutory requirements around disclosures that have to be included in the director's report. So they can't be ignored, that's really important. I thought I'd just list there the kinds of things that we see, and I tried to compare them to what's required versus what we often see. And probably give you an idea of looking it through this list of items, you could probably understand why I sort of maybe used the, again, tongue-in-cheek phrase, the neglected report, but we often do see some of the um, it's an area where perhaps some of the information is not updated regularly, and as a result, there's usually some legacy issues in those reports. So what's required typically? First one we see, number of unissued shares under option as at the day of the report. Now what we typically see, and sometimes see with other entities, is the number of unissued shares under the option as at the balance date, and then there's a subsequent event disclosure in the financial statements that tells you there's been some shares issued under option. Now, from that perspective, we go, well, we already know that there's two parts of your financial statements that are inconsistent here. You've got a requirement that says as at the day of the report, but you're actually not telling me what as at the day of the report necessarily is the case. Second dot point there, shares issued during or since the end of the year as a result of the exercise of options. What we typically see sometimes with entities is that the shares issued during the year as a result of exercise of options and subsequent event disclosures in the financial statements of the shares issued under option post balance date. Again, not quite matching up what we're required versus what we've actually disclosed. And again, it's the kind of thing that I would argue that ASIC will relatively quickly pick up on and say, well, that disclosure is not correct. Third dot point there, report need not give details of nature of liability cover or amount of premium payable in respect to directors' insurance to the extent that the disclosure of details is prohibited by the insurance contract. Now, there's nothing necessarily prescribes you have to say nothing or something, but I think the key part with this is that if you're relying on that exemption to say, well, my director's liability insurance doesn't permit me to disclose what the premium I pay or what the terms of the actual insurance are, then it's good to actually say that. Because if you don't say that, it's hard to tell whether you've failed to comply with the disclosure or whether you are complying with the disclosure because your policy actually says that you can't disclose things. So I think it's always a positive statement in that situation is always helpful because it resolves whatever issues that someone might have as to whether or not you're complying with the Corps Act. And the last one there, qualifications and experience of each person who's the company secretary is at the end of the year. Again, poor company secretary always gets left out. Often we don't see a lot of details around them, notwithstanding the Corps Act does say that you need to provide them. You only have to tell what their qualifications are and what their experience is, and usually it's about 2 lines. So again, it's not an onerous disclosure, but again, it's a legal disclosure. You've probably seen, if you've listened to some of our webinars before, you've probably seen in this slide, I've used it in the past, really just to reiterate the idea that you need to review your RFR every year just to make sure it's up to date, make sure it's fresh, make sure it's actually addressing the risks and strategy that you're actually involved in. Really important that it focuses on things that are relevant to you as an entity, not to what you picked up out of another model set of accounts. Make sure that you actually consider the ESG risks and opportunities. Again, something that a lot of entities don't do. And just don't publish boilerplate disclosures. I mean, boilerplate disclosures are pretty observable from a mile off. Like you can usually see them from a distance, and they are not helpful. And again, I would say that they're the kind of ones that I would expect to trigger a regulator. Actually, just on that point, I suppose another reason why I don't like boilerplate disclosures is because people tend to rely on them and forget that if their circumstances change, often don't update them to reflect that. So boilerplate's great, it helps you to get to sort of some wording, make sure you don't have to reinvent the wheel, but really, really important that you don't just assume that the boilerplate will cover you forever, because invariably entities change, their circumstances change, and when they disclose other information within your financial statements, it'll often make it very, very clear that the boilerplate's no longer applicable. Moving on to the REM report. It's an area, again, and I can't emphasise more strongly, a REM report is a legal document. It's not an accounting document, it's a legal document. It sits within the director's report. It has to be audited. It's not subject necessarily in itself to materiality. And so it's really important that the information in the REM report matches what's in the financial statements, because again, if directors are producing a REM report, and it's not matching the information in the financial statements, that's not probably going to go down particularly well if it's disclosed to shareholders before they vote on it. So a really important aspect to this is that it's not just a document that sits there, it's actually a document that's voted on. We don't often see prior period errors coming out in REM reports. I'm pretty sure that there's probably lots of prior period errors in REM reports because we don't see a lot, but entities do on occasions admit that they've had prior period errors and have to deal with them, and they're not easy things to deal with, particularly when you've had an instrument that's voted on by the shareholders. So again, the concentration, the focus on it should be very, very clear on the REM report, making sure that it actually says what you do and it makes it clear what you do and what you don't do. Kind of things that we see, I've sort of listed sort of a bit of a grab bag, but I've listed there in the slide the kinds of things we've seen pop up. So again, boilerplate. Typically, when the REM report says there's a remuneration committee and we know full well there isn't one, again, don't fall into that trap. Summary of and the explanation of why a performance condition was selected and how it will be measured. Often we don't see that. That's not something that's necessarily disclosed. Sometimes it's self-evident, and maybe that you can rely on that. So the idea that maybe you might be using a share price for an option as a basis for a share-based payment arrangement. You might say, well, that's it's pretty clear. It increases the value of the. If the directors increase the value of the company, then that's benefit to the shareholders. It's probably self-evident, but you need to think about it, need to step through it. Don't just assume that it's obvious. Again, 25% of the members voted on if 25% of the members voted against a previous year's remuneration report, you need to disclose the actions and what you've done to actually address that. And if you don't, then the failure to disclose, and it might be the case that you have to say, well, we didn't do anything, but that's still meeting the requirement, notwithstanding it's probably not what the shareholders necessarily want to see. The value in the exercised of options exercised by KMP during the year. And when KMP options lapse during the year, the number of options and the years in which they were originally granted, they're kinds of things that we often see where the details are not disclosed. So again, if it's not compliant with the Corporations Act, then it's going to be subject to vote and it's going to be subject to audit. So you need to be very, very careful about the details that you include. I'll leave the other ones too. Maybe the only one I'll call out there is the last one in the bottom right-hand corner. This one is a really easy one to pick to see if they've actually done it correctly, because they've got to also make the same director-related disclosures in their financial statements around KMP transactions, related party transactions and balances. On occasions, we see entities saying that they are meeting the requirements using cross-referencing. Now, there is nothing in the Corps Act that permits you to cross-reference necessarily. It is obviously a legal question, but the way I read the Corps Act is that basically saying you've got to disclose these things within that document that you call the REM report. And so the idea that you can cross-reference is, I think, legally challengeable, if maybe I'll use that phrase. So important to make sure that you cover off all the things that's required under the REM report. Moving on to maybe some of the more accounting related things. I've sort of touched on a range of those issues there. So looking at accounting policies, significant accounting estimates and judgments, risk disclosures, and maybe some other information. We're already in the market with a number of publications on these areas and talking about some of the things you can do to improve the quality of your financial reports. So again, recommend that you go and have a look at some of the BDO publications on there. I've provided some of the links in that slide. If we delve into these a bit more, so looking at things like cleaning up your accounting policy disclosures, again, I'll just focus on the first one there, inclusion of irrelevant accounting policies. So you might say, often we have entities will say to us, oh, look, I don't have any, say, non-controlling interest now, but what if I have some in the future? Okay, well, if you have them in the future, then you could probably include the note in the future. Well, what's wrong with including the note now? If you've got accounting policy on non-controlling interest, but I can't see it in your balance sheet, then my question would be, is it immaterial or does it exist? Now, or the third option possibly is, have you actually recognised it? And that's the kind of thing that as a regulator, if I was looking at your financials, I'm going, well, you're telling me about non-controlling interests, but I can't see them. You haven't reported them in your balance sheet or in your P&L. How do I deal with that? So that just elicits a question that you don't probably need to actually answer, or that you don't probably want to answer. But importantly, including that irrelevant policy actually creates a discussion that you don't need to have. So think about your policies, think about whether or not you actually are relevant to you, and make sure that those ones that aren't relevant are actually excluded. Including immaterial accounting policies, again, it's the question of, if I can't see it, but you've disclosed a policy around a particular item, why are you telling me about it? Is there something there that you haven't recognised that I should be aware of? Again, it's just eliciting a question that you probably don't need to answer. including generic accounting policies. Now, I mentioned before that boilerplate accounting policies are problematic, particularly over time, because they might be suited to you when you actually adopt them, but if you continue treating them as boilerplate and not your own, then the chances are that your underlying activities and your strategy will change, and those boilerplate policies will no longer be relevant. And usually the boilerplate policies are really self-evident. One of the ones, and I didn't include it in the slide there, but one of the ones we see nearly every year is when entities might say, well, look, we use the simplified approach to measuring expected credit losses. But then we get an accounting policy explaining the whole general approach to measuring expected credit losses. And we go, look, there's 4 paragraphs you just don't need. In fact, it's inconsistent with what you've already disclosed elsewhere. So not only does it create an issue for the market in the sense of investors looking at it and saying, well, I don't know how you work out your ECLs. It seems to be you apply both models. But it also creates the issue of, well, are you actually in charge of your accounting policies? Like, are you presenting your best face to the market? The last one there, repetition of accounting standards is not the relevant decision. So this is, in some ways, maybe some of this presentation is a bit of counselling for me, because one of the things that drives me nuts is seeing the 5-step process. So anytime I open up a set of financial statements and I see that they've included a 5-step process under AASB 15, I sort of say, look, what's the point of this? This is irrelevant to an investor. This is the process you go through, not necessarily what an investor needs to know. And so as a consequence, I often pull that one out and say, look, it's you just need to remove it, because it just doesn't have any relevance or any value to anybody who's reading these financials. Reporting issues that might require some further hygiene and how to do it. Consider actually just changing the presentation of the financial statements. And this doesn't have to be done during audit period. You can do it anytime. Sit down in January and do it, and it surprisingly will take very little time. Cull irrelevant material accounting policies, i.e. any policy that reiterates only the requirement of the standard. And I'll provide some examples later in the slides. Group relevant notes together. PP&E perhaps can be followed by right of use asset and lease liabilities. If information is relevant to more than one note, only include one and cross-reference. Yep. If you can. So you can't cross-reference between documents, but you can cross-reference within your accounting, within your financial statements. And include any relevant accounting policy judgments and estimates in the relevant note. And people sort of say to us, well, what would they be? Well, they're the ones which make a difference to the accounting outcome. So whether or not I consider this jointly 50% owned entity a joint venture or a subsidiary, I mean, that's a significant judgment that you need to disclose around. Ones where you're simply saying, I've applied a particular approach to depreciating the assets, again, may or may not be that materially important to investors. To help you probably when you're thinking about these things, what we've done is a couple of slides here. The first one here is thinking about what do we think of material accounting policies look like. I'll leave that with you. I won't go into detail with them, but I think the kind of thing that you should be able to, when you read through it, it should be sort of self-evident to you that there's lots of stuff in the accounting standards, but a lot of it is not about accounting policy or judgments or significant estimates. It's just about how do you do it. It's a bit like the stage directions. I mean, we can tell you the stage directions, but nobody really wants to hear them. What's the actor's voice saying? That's the most important thing. And as an example of perhaps how to actually move through kind of material disclosures, I've provided an example there. We've plucked this particular note out of a model set of accounts. I won't say who it was. And we've applied our sort of lens to it. And you can see what we've done is pretty much half the length of the note. And when you look at what we've actually removed, a lot of it is, again, it's the stage directions. How do I do what I do? The important part when you're talking about perhaps, and I think PP&E is a good example when you're talking about that, it's important to emphasize if there's just simply one measurement model applied right across the board, it's just cost, then fair enough. Or fair value, if that's the case. If there is different accounting policies applied to different classes, then you need to disclose it. Beyond the length of the depreciation, a lot of the other materials is, somewhat irrelevant to the investors. Things like residual values, useful lives, depreciation methods are reviewed and adjusted appropriate at each reporting date. We accept that. That would be a given. So we don't have to tell you what you're doing. You're just simply saying that's actually a given. So there's lots of stuff often in these notes, which we, particularly around accounting policies, we say, look, it's stage directions. It's not necessarily about what you're doing day to day and how you're actually accounting for it. And it doesn't really affect the number that's perhaps reported in the financial statements ultimately on those items. Significant estimates, judgments, what do they look like? This is an area that's a bit more complicated, but I think the important part is to make a distinction between, like, if we start from there, an estimate or a judgment. An estimate is something like a useful life. So my making an assessed estimate of a useful life. Now, if I felt like that estimate was different to what other entities in the same cohort for me were doing, then I might consider that it's worth disclosing. But if it's a really stock standard disclosure, so for example, I mean, it's not unreasonable to sort of, and we see quite a lot of it, entities depreciating, say, for example, intangible assets over 3 to 5 years, like software. That might be considered a pretty stock standard market assumption. Probably maybe it doesn't really deserve disclosure because it's not particularly material. If we are in a situation where you have to make a judgment about whether I control or have joint control over a particular entity and that entity has a material impact on my financial statements, that might be a judgment that you go, yep, that's important, and I actually have to explain it because that's the one that can make a significant difference to my financials. But it's also that judgment that you'd expect a regulator or an auditor or anybody else to drill down on, because it's the one that makes a difference to your financials. So making a distinction between what you think is material and significant, and making a distinction in your disclosures as well on that basis is really important. Which then leads us to maybe some perennial disclosure challenges. So just looking forward into the future, the kinds of things that we might see as important. Revenue disclosures. Every year we probably see some real deficiencies in revenue disclosures, and the reason I highlight it is because ASIC would be, and your auditors as well, are very focused on revenue. Revenue is considered one of those key risks in a set of financial statements. And so as a consequence, it's important that it's clear how you've actually recognised your revenue, but it's also important that you've measured it accurately. Now, it's been a bit of a brain dump there from that slide in terms of all of the different deficiencies we see. Maybe just touch on the first couple. Disaggregating revenue into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. Now, what we typically see is very limited or no disaggregation. Notwithstanding, more disaggregated revenue information might be disclosed in other formats to the market. So the important thing, and this is, AASB 15 does actually highlight that, to say that if you disaggregate information in a way, particularly revenue, and you disclose it to the market, why wouldn't we expect you to see that sort of same level of disaggregation in your financial statements? Again, it's one of those, I think that's one of those red ASIC would pretty easily and quickly pick up on and say, well, hang on, you're not disclosing in your financials the same way as you disclose to the market. Why is that the case? And is there something preventing you from doing it? The kinds of, and that's not to say that every entity has to disaggregate their revenue. So some entities might say, look, we sell goods across the counter. It's the same good. We sell it in the same good across all the shops in our. Maybe there's a little bit of difference in our markets geographically, but in terms of the product, the market, generally, the kind of customers we deal with, we don't think that there's any difference necessarily between one shop to the next. That's a judgment, and fair enough, that might be something that you can support. If, however, you're involved in a range of, say, for example, customer contracts, one of which, there might be one group of customer contracts with for-profit entities, there might be another group of contracts that you're with government. We would expect that those would be disaggregated at a level that you could make that distinction. And you might say to me, why? Well, typically the pricing around government contracts is different, and typically the ECLs around government contracts are different. And so as a consequence, you should expect that if your customer base are very different, then probably the nature of the underlying contracts are a bit different. And therefore, in terms of thinking about how the cash and the revenue is affected by the economic factors, you would expect that at least on a customer level, there'll be some disaggregation. The second point there, which again, is probably one that's something that sometimes people don't appreciate, but there is a clear requirement in AASB 8 and AASB 15 around segment disclosure and revenues. So the expectation is you disclose sufficient information to understand the relationship between the disclosure of disaggregated revenue and revenue disclosed at each reportable segment level. Now, there's a good example of the capacity to cross-reference in a set of financial statements. So you could potentially put all of your revenue disaggregation in your segment note if you wanted to, and just cross-reference to it from your revenue note, and cover off two birds with one stone. But what we don't see on a regular occasion is entities necessarily doing that. They tend to treat those two lots of disclosures separately, and as a result, we don't necessarily see the disaggregation and the understanding around the operating segments and how those revenues are disaggregated. I think I might leave it at that. I mean, you can read that slide at your leisure and have a look and think about what we're doing. But I mean, revenue, I think, is one of those key areas that's, perennially probably could do with a lot more disclosure and could do with a lot more detailed disclosure. Segment reporting, again, another area is sort of aligned with the revenue recognition. Segment disclosures, I think the important thing with segment disclosures, and it's a relatively easy thing to sort of get your head around, is the idea underlying it is that it's through the eyes of management. So if management are looking at something or they've actually provided with that information, then we expect to see it in the operating segment disclosures. Now, underlying that is the principle that if management think it's important, well, why wouldn't users think it's important? And it's interesting, I remember one of the past chair of the AASBs saying to me in respect to segment reporting, he thought it was actually a good disclosure tool because it also indicated what management are not looking at. And so as a consequence of understanding exactly, well, if they're not looking at that, is that important and why aren't they looking at that? So it goes both ways, but it's a quite useful disclosure and it's grown in terms of an area that ASIC look at quite closely because it does go to exactly how the entity is managed. So it's got a governance plus an accounting aspect to it, which is really important. There is the aspect of with segment reporting, obviously there is the possibility that there's going to be some non-IFRS numbers involved in there, provided again that they're reconciled and it's non-IFRS numbers that the chief operating decision maker actually looks at, then that's fine to disclose them, but an important part is to reconcile, to explain. And that's one of the requirements in the operating segment things to reconcile. I suppose the other point I'd like to make too is that often there's going to be some overhead. There's always some corporate assets that don't necessarily fit into a segment. Those corporate assets are not typically a segment in themselves unless they actually can generate income. So it's important to keep in mind that when you're doing this, that's the point of the reconciliation. The reconciliation provides you the opportunity to true up whatever numbers are in your operating segments against ultimately the entity's assets and liabilities and the revenues and expenses. Provided for your benefit there, just some sample disclosures out of our model financial statements, the BDO model, global model financial statements, just to give you sort of a sense, and I just wanted to highlight there too, that idea about the reconciliation of the segments, the numbers and the revenue. Income tax note disclosures, again, probably an area that is usually left maybe to the tax accountant and not necessarily looked at by the CFO, but what we do see is generally often the numbers don't match up. And again, as a flag to ASIC, I would say, look, that's important. And maybe it's a flag to the ATO as well, that your numbers, if they don't match up in your income tax reconciliation, then there may be something else more deeper going on that they want to examine and look at. Common disclosure deficiencies there, I've just listed them, I'll touch on a couple of them. Reconciliation from operating result to taxable position, they don't reconcile. Material reconciling items in the tax reconciliation must be explained. So you must explain things like prior period errors or prior period adjustments. Current and deferred tax expense of items recognised in OCI is also recognised in OCI, so it's interesting, those things pop up. Not regularly, but we do see it often on occasions and they have to be disclosed. You can present your OCI items net, but you have to somewhere disclose actually the tax component. Tax expense must equal the sum of the current and deferred tax. It seems self-evident, but we do on occasion see the tax note being presented to us and they don't match up. And the correct tax rate in the tax reconciliation must be used. Again, consider what the entity circumstances are, what's the correct tax rate, and make sure that reconciles. Quickly on consolidated entity disclosure statements. This year was the first year that we actually looked at those, so I'm hoping going forward the disclosure won't be an issue, that entities will get them. The really important thing with the consolidated entity disclosure statement is the same with the REM report, is that it's a report that's required under the legislation, and so the types of things you have to disclose are relatively non-negotiable. The kinds of things that when we first started looking at these and when entities first started preparing them, immaterial and dormant entities were often missing. And so they're important to be included because they are part of the tax group. Again, this, as go back to my original comment about anything under the Corps Act tends not to have a materiality out. And so as a consequence, things like immaterial and dormant entities obviously have to be included in the SEDS. Other issues we saw that was probably an issue, basis of preparation for the SEDS to be included, so explaining how you actually came to the conclusion about the entities within the group and how you decided which ones were actually tax paying. And it includes information disclosing the tax residency of each subsidiary. This one's actually a good one, and I bucket this within, maybe if we're talking about a broader hygiene issue, I bucket this one closely with things like leases. So tax leases have similar issues, or we find have similar issues, because often from a CFO or a corporate finance perspective, you need to talk to somebody else in the business. Now, because often you don't have that information necessarily directly to hand. If you don't have that, then obviously building those communications is really important. An example in the leasing arrangements we often see is where entities, so the property team will often go off and involve themselves in deals, but don't necessarily communicate all or particularly the right information necessarily to the corporate finance team. Same with the tax effect. So if you're dealing with the group accounts and you've got overseas subsidiaries, who do you talk to about who those overseas subsidiaries are? Getting the right information at the right time. Building those kinds of communication links are, I think, essential to hygiene, as is probably just having a good old-fashioned scrub of your financials every year, just making sure that they're clean and making sure that all the details in them are correct. One way to keep them clean and correct is minimise the amount of information that's not required in them. And I think that brings me to that point, Aletta. I hope I've convinced everyone of the importance of hygiene in their financial reporting. Sorry, Aletta, you're on mute.
Dean, and also the fun in cleaning up the financial statement disclosures. Thank you very much.
I'm not sure if I did, but anyway, if I did, great.
Dean, thank you very much. I think there were some really amazing observations, and talking about the importance, if it's a regulatory aspect, that we don't have materiality to get out of it. That's what we have to do. I think that's an important point that we often forget, but also on other places where we can cut out some things, that's just repeating the obvious. And you have to make it bespoke to your business so it adds useful information. I think that's fantastic. So thank you very much for that. I thought I'll just round up the session with a little bit of how we can help you. So from an IFRS corporate reporting perspective, so that's all things IFRS accounting standards. We're very fortunate that we've got partners right across the country. So Clark, based in Brisbane, Kevin in Sydney, Dean and I are both in Melbourne, Lynn Dow is in Adelaide, and Ashley Woodley in Perth. So please feel free to reach out to us. I think the sooner the better. So if you've got complex transactions and you want some guidance, or you want us to help with preparation of financial statements, reviewing disclosures, etc., please feel free to reach out to all of us. And all our details on our website. From a sustainability perspective, as you know, we've talked about 2025 is the year of sustainability reporting. We focus on 4 key areas across our whole BDO business. So carbon accounting, sustainability reporting, a sustainability strategy, and sustainability assurance. So assurance is where you reach out to our audit partners. But for carbon accounting, sustainability reporting, and sustainability strategy, that's within the advisory business. So I think on the next slide, I've put a bit of a description. So what do we do under carbon accounting? Measuring your footprint, doing baselining, setting targets, etc. Sustainability reporting could be mandatory reporting, so AASB 2, could be voluntary reporting under another framework. Strategy is what is our current state, what is a materiality assessment, what do our stakeholders want, what are the gaps, what data do we have to collect, measure, report. and then obviously assurance. And then to make it a bit easier for you, on the next slide, we've put faces to the different areas. So carbon accounting, you can see there's people to contact across Brisbane, Melbourne, Perth, and Sydney. The same with sustainability reporting, the same with sustainability strategy. Please reach out to those individuals in those locations. And then on the final slide, we've put in our sustainability advisory leaders, really. So again, across the 5 locations, who are the people accredited? And we're in a process of accrediting all our audit partners, but they are leading the charge in those locations. Dean, I think we rounded off by saying thank you very much for everybody for attending. Remember, next month we're talking about accounting for power purchase agreements, and next week we're running a session on sustainability, and we're looking at AASB S1. I hope you enjoy the rest of the day, and we'll speak again soon. Thank you, Dean, and goodbye, everybody.
Thanks, Lena. Bye, everyone.